My 2023 market forecast. Here it is. You ready? Du-du-du-du-du-du. Right there. Stocks down 18%. I probably should do a plus here. And bonds up 12%. That's my 2023. Let me write this down. 2023 forecast. And lock this in your brain, and we can look back and see if I was right. 2023 market forecast. Stocks down 18 and bonds up 12. Now, people say, well, how did you get that? Well, just like everybody else, it's a complete, pure speculation. But we'll start with the stock market. All right, so the stock market is down so far this year. Let's take a look here. Total stock index is down 17.59% year to date. It was as low as, I think, 25% or so. Yeah, about 25%, which is, it's full-fledged bear market. That's a day in the park of bear markets. But we're seeing it's come back off the high. But you can see it's a dead cat bounce. Is that a dead cat bounce? But anyway, you can see it's had twice now. It's been down in the 20s. And that's that's fine. But after the run we've had since 2009, that's just a big fat nothing burger. But it doesn't matter, because always what matters is where does the returns come from? As I always, this is for stocks. We'll talk about bonds here in just a second. And returns on stocks are only two places and two places only, other than contraction or expansion of price to earnings ratio. That's it. So you got earnings growth plus dividend yield equals rate of return. That's it. Earnings growth plus dividend yield. That's your historic rates of return. Now you can add a plus or minus PE contraction or expansion as a third aspect of this. How much people are willing to pay for a dollar of earnings. You just don't know. And that's the thing with PE ratios. You just don't know. What are people willing to pay for $1 of earnings? I would expect to be willing to pay less for a dollar of earnings next year than this year. So we'll have PE contraction on top of earnings growth contraction, and dividend yield will probably stay the same as it is today. Now, dividend yield does change based on depending on the price of the stock. I don't get that much now, but basically dividend yield is 2%. So you have a dividend yield of 2%, a 4.5% earnings growth year over year. You'll get on a 6.5% rate of return. I don't expect that for next year, and I'll share with you why. Sundance at the conservative treehouse, maker of electric Jeep vehicles, closing Illinois plants and moving to Mexico. Now that would be a boon, a benefit to the earnings, generally speaking, when they're laying off people. It's a short-term benefit to earnings. It's a long-term negative, though, that's for sure. Multinational automaker contracted for the electric vehicle, the Jeep Cherokee, citing high cost to produce electric vehicles. It announced it'll idle the Belvedere plant and instead move 1,350 workers will be subject to layoffs. The high cost of energy is going to hurt earnings, and we're going to have, and I truly believe, negative earnings because of high cost of energy. Negative earnings inherently is recessionary. There's just no two ways around that. Part two of this, and look, I mean, this is just an anecdote, I grant you, but the cost to produce products is not cheap, and it's only getting more expensive. The energy costs are high. The labor costs will be higher because there is a significant need for labor. And the need for labor, the demand for labor raises prices. The biggest cost to the cost of goods sold category of a corporation is labor. So if they got to raise their cost to hire people and retain people, that's just going to go into the cut into their earnings, which means the contraction of earnings growth. That's what I forecast. I could 100% be wrong, but whatever. I mean, this stuff happens all the time. So you have a contraction of PE ratios, how much a person is willing to pay for a dollar of earnings. You got a leveling off of current yields roughly about 2%. Right now, it's not even 2%. But the reason I say 2% is because when the prices decline, as long as the dividend remains stable, the yields go up. But I don't expect much in that regard. So then you're looking at earnings growth. Where's the earnings growth going to come from? Well, the cost of energy the cost of labor factored in means the earnings growth will not go up. It'll probably go down, and thus we have a decline in the markets. On top of that, part two of this is interesting article I read yesterday, right here. From our research, this is 314 research, the market has never bottomed before an official recession. The market rarely bottoms when the Fed is still hiking rates. All right, so we think the Fed's still going to hike for a little bit, probably until the Q1 of next year. Stupid, because they can't control anything, but be that as it may. But the Fed has never bottomed until an official recession is called. Now, this is interesting because you could say we had a recession in Q1 and Q2. We did. We had a technical recession of 2 consecutive negative quarters of GDP. But it wasn't really called an official recession. So, okay, so I'm going to go with it and say we haven't had an official recession. As such, Q3 is positive in terms of growth. And then Q4 looks like it'll be positive as well. So we don't have an official recession until at least the end of the second quarter, well, going to July, when they call it an official recession, most likely. Because it's quarters, GDP growth or contraction. Quarter over quarter. We're not in a recession right now. We could be. I don't think so, though. So the issue is, if we're not in a recession now, that means we'd have to be in one at the beginning of Q1 of 2023 and into Q2 2023, and they would call it in the second week of July, maybe in the second week of August. And that is when the markets, this guy says, the market has never bottomed out before an official recession is called. Hey, before an official recession. So the earliest we can get to an official recession would be, I guess, would be actually the second week of August of 2023. All right, let me let my dog out. In that case, the market would have bottomed out probably in September, something like that, and then it'll come back rising to end the year. And so I would expect the markets to kind of seesaw a little bit, go down, and come back. Well, that's probably. Let me show you what I'm talking about. I would expect that's probably pretty good actually. A little bit less. I would expect the markets to seesaw, go down, and come back up like this. This is what I would expect. Now remember, we're already down 17%. So we're already down 17% here. You know what I'm saying? So we get to the trough. Is that what's called the trough? We're probably talking a total all-in decline of negative 35% or something like that from top to bottom. So this would be another 18% down, maybe 20% down. So we're already down 17 here. It's going to seesaw. It'll drop. Then we'll be down to another 18 to 20%, and then it'll come back up to end the year at negative 18. What I see at negative 18. That's what I would expect. All right, so the bottom will probably be in September 2023, and then it'll claw back some of the gains at the end of the Q4 of 2023. I would expect, but we're still going to be down for the year. All right, now part two of this is bonds. Bonds is pretty simple, man. I mean, so anytime we've had a significant pullback in bonds, the next year the market has just run rampant, and I absolutely think that's going to happen again. The Fed will stop raising probably in Q1 to 2023, and then the bond market will just take off like a bat out of hell. Like you can look historically, any time there's been a significant pullback in bonds, and significant is 3 to 5% on any given calendar year, the following calendar year, it's freaking gangbusters. And I would expect the same. I would not be surprised if bonds had a 20% rate of return, frankly. I can't call it that. That's too much for me. Now, again, we have gone through the worst bond market anyone who ever walked on the face of this earth, walking today is alive, has ever seen. And the bond markets claw back some of that, but not nearly enough, because they're still like, well, the markets, are they going to raise some more? And I do believe the Fed will raise again, probably 1 or 2 more times, just to prove that they still are relevant, and they're not. But when that stops, I think the bond market will go bat out of hell. All right, so that's my prediction. All right, now what does that mean exactly? Let me show you. All right, so if we go to stocks, basically 5.7 is the average rate of return for stocks. Mid caps and small caps get a little bit bigger, but stocks 5.7, 5.7 for international equity. I mean, I just don't care all that much. 7% for emerging markets, whatever. Government bonds 4%. All right, municipal bonds 2.5, corporate bonds 4.5. All right, and then we got other. This is the big one right here. Other is only 5%. So this is what I'm looking for right capital. We'll get into this here and what this means in just a second. Let me So let me show you what I'm talking about. So if we have a U.S. Total stock index, we get a 6% average and a 17.3% standard deviation. I'm not going to go too deep in this because I've done this not that long ago about standard deviations. That means on any given year, the portfolio could be down 34, 51, 52, minus 6, 46%. All right. So in this case, all stocks, you could get, your expectations would be on average, you get 6% return. But in any given year, it could be down 46%, or it could be up 60%. That may or may not happen. That's what I'm using for 3 standard deviations. Now, if you go to an all bond portfolio, you see your average rate of return is 4.1 with your standard deviation about 4.5. So just for simplicity, we'll say that's 14. We'll say 15 for simplicity. So that means on any given year, you could be up 19 or down 15 minus 11. All right, so that you can see. So you're not getting the same rate of return as stocks, but you're getting a whole lot more less volatility as well. All right, now that's already factored in the software, man. All right, so let me show you something. All right, so here we got Ann and Dan's sample. They only have a 51% probability of success. Well, that's already factored in the returns that I'm using. All right, now I don't even know what their current allocation is. Let's see. Their current allocation is 60, basically Wellington portfolio. 5.3% is their average rate of return. 11% is their standard deviation. So these downside risks are already factored into it. Remember, in this case, they can average 5.3% on average from now until they go to the God's reward, but they have an 11% standard deviation, which means they could be down another 28% next year. That's already factored into the software. We're already assuming that happens. I hope that makes sense. We go to confidence, you can see these light blue. So basically, that is your median. The dark blue, that's your vein of life of investment returns. That's your median. 50% of the time you have more, 50% of the time you have less. This is just a fake sample. This is not a real client. And you can see it just drops. It drops, it drops, it drops. But if we have a market decline of 28%, 5% of the time, you could have less than $215,000, all right? And that's in today's dollars. 5% of the time, you could have less than 215. Now, on the other hand, 5% of the time, you'd have more than 312. But you can see how this works. If you go way down here, 5% of the time, at 76 years old, you could have less than $29,000. 5% of the time, you have over 271. The point being is these negative returns on any given year are already factored into any kind of Monte Carlo analysis that anyone does. It's just what you use your inputs. And again, in this regard, I'm using an input about 5% rate of return with 11% standard deviation. So to change your portfolio because next year it looks like it could be negative, that doesn't make any sense. We're already factoring that in, even more than what I'm showing you here. So don't change your portfolio. Say, well, I'm going to avoid next year's losses. No, it's already taken into consideration, man. And then, what's the point of a market forecast on any given year? Just nothing other than to make sure that when it happens, you're like, yeah, okay, I already factored that in, that you don't jump out of a bridge. It's just that simple. Hang in there. If you can't sleep at night, then get the hell out. I got no qualm with that. But the point being, this stuff is already factored into your Monte Carlo analysis. Even if you're using me or using somebody else, if they're running Monte Carlo, and I guarantee you they are, they're already factoring the stuff in. So why would you change anything unless you can't sleep at night? And secondly, I could easily be wrong. The hell's bells? That's just one guy, my t-shirt, and my dogs. I didn't even shave this morning. So, I mean, just because I say this doesn't make it's right. Some guy on my live stream last night said, well, money managers, successful money managers are predicting a 10% rate of return on stocks. Oh, well, whoop-de-flip-and-do. Wow. Stock averages 10% per year since 1926. They're predicting a 10% rate of return. Oh, it doesn't top money managers. That's what he said. I don't care. And you shouldn't care either. Are you comfortable with your portfolio? Did you buy it with no expectations to lose money? That's nuts. Remember, you don't actually lose money until you sell anyway. All right. Love your thoughts. Put them in the doobly-doop. And if you want to subscribe to my email, the email link is right there on the top link in the Gooby Doop. And if you join me on Locals, you'll see that link as well. All right. We'll see you guys.